Welcome to episode 4 of Apropos, the latest in senior housing, mapping COVID-19's toll on the industry to today's ongoing challenges. I'm Patrick Nessenthaler, founder and CEO of Ness & Associates, and I'm joined by my co-host from CFA Society New York, Robert Rohn. In this episode, we'll unpack some of the topics that are apropos to critical challenges confronting the senior housing sector in the United States. We'll explore the trifecta of concerns: affordability, accessibility, and availability. Additionally, we'll delve into the transformative integration of technology, which is an instrumental tool in fortifying safety measures, enhancing communication channels, and broadening seniors' access to vital healthcare services in America. During the intense scrutiny of the COVID-19 pandemic, stringent lockdowns and safety protocols aimed at safeguarding seniors paradoxically exacerbated their isolation. Restrictions on visitations and communal engagements inflicted a toll on mental well-being, leading to heightened loneliness and depression among our senior population. Beyond the human impact, the COVID-19 pandemic also took a significant financial toll on the industry, especially the skilled nursing sector of the care spectrum. As regulatory leniency during the pandemic shielded financial distress within these senior housing communities, a stark reality now emerges. We can no longer defer addressing these financial challenges. With our guest, Mr. James Scribner, actively engaged in the non-performing loan market for this asset class, we anticipate an influx of distressed opportunities surfacing in this marketplace in 2024. So, what are the significant ripple effects that will be felt in real estate financial markets associated with this asset class? A lot to unpack to answer these questions. Let's get right into it. I do want to start off providing a brief bio of our esteemed guest, Mr. James Scribner. Mr. Scribner has nearly 20 years of senior housing investment experience. James has completed senior living and long-term care financings total over $2.5 billion, including $450 million in equity and subordinate debt, as well as over $1 billion in FHA, government agency, and first mortgage financings. He has also led over $200 million of restructurings and distressed note purchases. His senior housing experiences spans equity, mezz, and first mortgage financing of life plan, continuing care communities, rental, independent, and assisted living communities, as well as skilled nursing facilities. James started his senior housing career on the investment banking team at Herbert J. Sims and Company, a boutique healthcare investment bank. During his time at Sims, he structured senior housing and healthcare private placements for both accredited and institutional investors. And in addition to his banking responsibilities, James had ongoing asset management and investor relation responsibilities for the portfolio. After his tenure at Sims, James joined Red Capital Group, a leading FHA insured and agency lender to grow its balance sheet lending platform. In 2017, James and his Red team joined Hunt Real Estate Capital to build a senior housing healthcare vertical. While at Hunt, the team was successful in obtaining agency, Fannie Mae and Freddie Mac senior housing lending approvals. In 2020, James founded Scribner Capital, LLC, aimed at providing stable and flexible capital to senior housing and healthcare asset stakeholders. Scribner Capital entered a strategic partnership with a multi-billion-dollar institutional fund, leveraging their expertise in municipal and public purpose investing. The company offers various investment strategies, including JVs, mezzanine debt, rescue capital, as well as distressed asset purchases. It also provides co-GP capital to smaller operators focused on controlling real estate and operations. Under Scribner Capital's umbrella, SC Investments LLC holds principal investments in 16 senior housing communities, totaling over 1,400 units and an approximate asset value of $350 million. James's leadership and extensive experience in the senior housing industry position Scribner Capital as a vital player in providing financial stability to this sector. Quite the background, James. Really appreciate you taking the time out of your busy schedule to join us today.
No, my pleasure, Patrick. Great to be on this call with you. And if I didn't feel old before, you're making me feel a little old now. But I've spent my entire career in senior housing and healthcare, so it's been fun.
Don't read your LinkedIn profile then.
We swap old with tenured. So. All right, so let's jump right into it. So we talked about the trifecta: affordability, accessibility, and availability. How has the COVID-19 pandemic magnified these vulnerabilities? And how can the industry navigate these challenges to ensure better support for America's seniors in the future?
That could take a whole hour. We could spend the entire hour talking on that one particular question. A couple of comments. I guess I would start by understanding the landscape of senior housing. And you mentioned skilled nursing as well, right? They're very distinct asset classes. What we're going to talk about here today is more senior housing oriented, predominantly private pay. Although when you talk about affordability, Medicaid waiver, it is a part of that paradigm now. So the private pay senior housing landscape does include Medicaid waiver in those states that are high quality payers. And there's only a handful of those, but oftentimes those buildings have a combination. And then it's really the spectrum from excluding active adult. So, active adult would be more multifamily oriented. But you mentioned life plan communities, entry fees, CCRCs, all the way through assisted living, memory care. And really the way to discern sort of a senior housing asset is it has a commercial kitchen. It has the programming. It has meals. It has usually 3 meals a day. Independent, it might be 1 meal or something. So the lens that we're looking and the conversation we're having is really focused around private pay seniors housing.
Right.
And when you talk about affordability, it's honestly a largely unaffordable product for a lot of America. I mean, it really is for that top 5%, 10%. That is improving. Nick has had a large focus on the forgotten middle, which is important, right? If you kind of look at the population, and we'll probably use the term baby boomers. Baby boomers are not the residents today. There are some, but that really has nothing to do with senior housing today. Their parents are really the ones that are in senior housing. So, the affordability question is a challenge, and the pandemic has really made it more difficult. When you look at development costs, right? I mean, new development is down substantially. It's almost impossible in today's environment to develop affordable seniors housing. It's an oxymoron. Right. There are groups trying to do it. We took a really hard run with a great operator and developer in Florida to develop affordable seniors at $140,000 a unit, give or take. Very efficient buildings. We went back up pricing, and it wasn't going to be $140,000 a unit. It was going to be $180,000 a unit. That just doesn't pencil. So, the other issue, that's happening on affordability is, as a result of the pandemic and inflation and wage pressure, you can't take a building for free almost and make it profitable and pencil. Right. So, to just say, well, we'll just repurpose a 20, 30-year-old Brookdale building, and that will be the affordable product. It's really hard to make that work, because when 60% of your labor, or 60% of your expense items are labor related, and labor is running hot, you almost can't push revenue fast enough to cover those expenses. And so obviously, when you look at a P&L for a senior housing building, and it doesn't matter, independent living, assisted living, right? I mean, they're order of magnitudes, but it's an operating business. And so as an operating business, that your primary cost centers are labor and wages. And so when those are rising at 8, 10, 12%, things are a lot better today. But, when you compare it to where we were in 2019, I hate to say it, you could be paying a lot of people minimum wage to do a lot of this work and have plenty of labor supply. Today, you're competing with everybody. There's minimum wage requirements in Florida, in California, in many, many states. That now, a lot of the workers in the industry don't make minimum wage, but it doesn't matter, right? It's rising tides. As the floor labor wage rate goes up, everybody's labor costs go up, and so affordability is a huge challenge. One of the ways that it's not being solved very well in the private pay space, to be honest. Just it's hard because we own some buildings. I was just at 2 buildings yesterday, 3 buildings, one that we're in the process of acquiring. Secondary, tertiary markets down in Georgia, the average rental rate is under $4,000, right? That is very affordable, but that's also pretty expensive for those markets. And these are older they're somewhat older buildings. They're not your brand new buildings. They're 40-unit buildings. They're really targeted to that resident, and you need to staff it very efficiently. Try to meet those affordability requirements.
Well, as maybe I could just go a little off piste here, but you mentioned this building that you were working on in Florida. What types of efficiencies were you all seeking in that?
Yeah, so that's a good question. So there's twofold. The first part was in the building footprint. So building footprint, less common space.
Right.
that's one of the challenges with senior housing. And one of the challenges, again, I've been in since '04. What a great time to get into it and then have the world fall apart and have to asset manage and work out all the deals that I don't think I knew how to put together at the time, but I put together. Why reading all your loan documents and JV documents are what each of those terms mean. But the efficiencies in the building, what the goal was to be able to tell somebody, a prospect, a family member, is that yes, we have a salon. Yes, we have the theater. We have, we check all the boxes. We're just not necessarily checking them at the scale that the new building down the road that's being built for $350,000 a unit is checking them. And to be honest, when only 60% of your building is rentable, it's really hard, right? You have 40% common space. You got the kitchen, you got dining, you got private dining, you got common at the end of the hall, you got outdoor space. It's really hard. So shrinking that down to be more like 20 to 25% common space, making rooms that are a little smaller but efficient, in their layout. But the big part of it was staffing. So coming up with, hey, we don't need a full-time driver, but yes, we need a van. We need a transportation program. And so it's not quite a universal worker, but that's a term that's used frequently in the industry that was used, certainly going back a lot, before I got into the space, was a universal worker that kind of do everything. A caregiver, a housekeeper, a driver, and have flexibility.
Again, we could spend so much time on this topic of affordability, and we talk about just designing something efficient, which is super, super challenging. But I'd say some of my opinion and some of the issues are really focused on DC, and we're so married to 1960s legislation with Medicaid and Medicare, and super, super challenging for us to attack, the healthcare industry at the federal level. But I think there needs to be some sort of subsidy, some sort of regulation that brings some sort of subsidy to make it a little bit more affordable for. You said 5 to 10%. I mean, we're missing a whole 90% of the community.
We are, and I'll just touch on that real quick. There are certain states. Indiana, for one, just passed new Medicaid waiver rate. So AL Medicaid waiver. They've always been a good payer. I forget the number off the top of my head, but it's north of $4,000 a month for a Medicaid resident. Pair that to other states where they don't even have the program, or they might pay $2,500 a month. Like your cost is more than $2,500. Other states, in Ohio right now is going through a large Medicaid bump. Should be approved by the end of the year, and then there's a couple other states that are contemplating, Pennsylvania being one, right? And the concept is get them out of a nursing home, right? Get them into the appropriate setting. Instead of paying, $400 a day, you're paying $120, $130, $140 a day. And it's kind of better for everybody. The concern is creep, right? That all of those more people end up on Medicaid as a result of that. The data doesn't necessarily prove that out. And I think from a social humanitarian aspect, spending a lot of time in nursing homes, shared units, 3-bed, 4-bed wards, needing 3 or 4 residents in a room, and that's where they put the Medicaid residents. The Medicare residents, which is the private pay type, the higher quality payers, they're in the private units, right? And so having a resident that can have dignity in a Medicaid building. We're buying a building in Oregon right now, and about 20% of the building is Medicaid. So that's a state that's a good payer. I think there's a 10% requirement in assisted living in New Jersey. So any new license, you have to have 10%. I think those are probably the approaches that will allow for maybe the private pay world to subsidize, Medicaid payer.
Got it.
Right.
That's good to hear.
And then just, availability, I'll just talk real quick. Supply. I mean, the starts are way down for obvious reasons. There's very little equity capital for it. There's very little debt capital. Some of the projects that are happening, maybe they're using, PACE financing. They're being creative, and they're probably deals with really good sponsors typically that are in really good markets. So, certainly the marginal developments are not happening today. So,
right.
Just to finish that point, I think that over the course of the next year, maybe 2 years, you'll see periods of times in certain markets where you have negative inventory growth. You're going to see more units coming out of service than coming into service in many markets. And I just heard of one shutting down that's a competitor of ours in Knoxville, Tennessee. So that's a good thing for us.
Yeah. I was going to say some of these things are actually good for you, but you point out on something else that's happening. PACE financing is being reviewed by a lot of legislatures now. So it's doing the old, federal, now state level 1, 2.
Yeah. And that's been popular. That's been popular these days with some groups, but I've also seen some deals crater in that now the building's not worth the PACE financing. The project's not worth the PACE financing. Never mind the senior first mortgage debt. That's in front or behind, however you want to think about it.
Well, again, we could talk about this all day long, but so I just kind of want to move forward. And we talked a little about debt and equity and kind of this new, CPACE is kind of a new type of structure that's entered the industry. But I want to kind of rewind back to COVID-19, and you mentioned that you entered the industry in 2004. Obviously, if you entered the industry in 2019 when the pandemic happened, not a good point of entry either. But I was actually going through some distress restructures during the pandemic. It was mostly in the retail world, but obviously we had some stressors that impacted the senior housing community. So I want to talk, we've talked about this several times offline before, James, but I want to talk about some of the regulatory leniency during the pandemic, kind of regulators kicking the can down the road, lend and extend, kind of look the other way when we're essentially in some sort of default, whether it's financial or covenant default or something along those lines. So I just kind of want to talk a little bit about the leniency that happened during the pandemic. And now we're getting into a point where we're getting back to some sort of fundamental equilibrium, regulations coming back, regulators starting to stress some of these banks and their portfolios. So I want to talk a little bit about that.
Yeah, happy to. And I think the steps that were taken by regulators, by lenders, were all spot on, right? I mean, this is for our industry, for senior housing. I mean, the impact of COVID on the 85 plus resident, I mean, there's a 20% mortality rate. It was meaningful. I saw buildings that lost 50% of their residents in a course of a month or two. Especially hard hit in some memory care units where, I mean, it was sad. Combine that with the staffing challenges, and you're asking these people to come in and live in the building. I mean, people were just living in the building and doing whatever they could. They couldn't get access to the PPE, and it was a challenge. And so there was a ton of waivers. No payments for 6 months, no interest only for the next 2 years. Nobody that I knew during that window of time was really, ultimately in default. There were a few really bad situations where new developments that they were already in trouble, right, in 2019. Right. But, there was a lot of leniency given, and I think appropriately so. Now, we had, stimulus funds. That was great. We had the employee tax credits, especially for the mom and pop types and the regional operators. That was huge. And honestly, there are a lot of operators right now that are still waiting on their employee, retention tax credits that really need them, right? Like they're not out of the woods. Like they were funding their projects. They were writing checks to cover operating losses, to pay debt service. I promised to get hundreds of thousands and in some cases millions of dollars to keep people on their payroll. And it was supposed to come last year, right? It was supposed to come, and now they're in a challenging situation with their lender because the regulators really in I would say earlier this year, started to really go in and kind of say, hey, COVID that was in the past. Like you have to look at these deals on their face, and we're gonna criticize them. We're gonna mark them down. If you're not marking them down, we're gonna come in and go through them with a fine-tooth comb. And there's a lot of bankers that I talked to, a lot of friends in the industry, and they said, hey, our regulators changed. Right? It's a new person. Right? They walked in the door, and they don't care. And we're dealing with that on one of our transactions right now. That we bought it 44% occupied. We're now up over 80%, but that's over the course of 3 years. Like it's been a battle. Great operator, low leverage deal. We got an accommodation. Basically, hey, free year. We had to post some cash, but no covenants, interest only for the next year. That's coming up. And we're not yet covering debt service. We're close. We're getting there, but with wages the way they are, and you can't jack up rents as quickly as you'd like. And it's not just rents. In the senior housing, it's rents plus level of care. And expenses came up a lot faster than those items have.
Right. This is related to one of the topics that I think I didn't know in my prep for this. I thought was interesting is a lot of people in the senior care industry seem to not be talking about the property insurance issue. And you haven't really mentioned that yet. Is that because in obviously some states it's going up a lot faster than others? But
yeah. So that particular building is in Florida, coastal Florida. Okay. The insurance is through the roof, to be honest. But it's a small line item in the grand scheme of things in our industry. So it is meaningful. But we want to save money for sure, and we're managing that. And we work with several brokers to get the best possible policies in place. But Florida's tough. Other states are tough as well. But, on the margin, it's labor. It's agency labor. I mentioned labor, but agency labor is just a margin killer in the senior housing space.
So, again, I want to just kind of move on. It was helpful background, and we'll get a little bit more into new regulators. That was the past, and how it's going to create some opportunities, at least in the stress space. But I'm sticking with dystopia for now. I want to talk a little bit more about, just again, COVID, just a super profound impact, on the mental health of seniors. Obviously it impacted my mental health. I couldn't imagine being locked in a healthcare facility with no contact to my family. It's just super challenging. It was a super challenging time. But I guess, how is the industry responding to that? How we're trying to correct, some of the seniors that went through that type of process, and, God forbid we go through another type of pandemic. What are we going to do to mitigate some of the issues that were caused by COVID-19?
Yeah, that's a hard question, Patrick. That's a very hard question. And in general, senior housing got a bit of a bad rap. And I think that's because it got, associated with skilled nursing, and a lot of this was in somewhat worse, and for obvious reasons. There's been some research. I would say anecdotally, I think your mom, your dad, your parents are better off in a senior housing facility where they're equipped to take care of you, right? And to have socialization, even if it's with a mask on or what, it's, that food is going to be brought to them, that they're being tested, and staff is being tested. So there was a report out that there was a slightly better resident experience and less COVID in senior housing communities relative to the general population. Your point on mental health is spot on. I guess the reality is a lot of the residents that moved in are higher acuity, frailer, have a shorter length of stay. And I hate to say it, but if you moved in 2021, there's a 50% chance or greater that you're not there today. So, as far as, I'm not seeing any, psychiatric assistance for seniors necessarily. I know that I actually was talking to a group that was exploring that strategy, trying to roll out sort of mental health to seniors, telehealth oriented mental health, which actually I thought was somewhat interesting. I don't know if they got traction on that, but it is real. But I think in the hierarchy of priorities, it just tends to fall down the ladder a bit.
Well, I want to talk a little bit about, again, it's you talk about priority hierarchy, but obviously technology. The first thing I think about when I think about technology is artificial intelligence. But you have virtual reality, you have augmented reality, and you let's infuse that into senior housing communities, and the ability to kind of establish some sort of community, whether it's virtual or not. And I think that. So I just want to talk a little bit about technology. Let's get out of this abyss of negativity and to see how technology is really being infused into senior housing communities. And I guess what you're seeing that's kind of apropos right now in terms of technology.
Yeah, no, there's lots of great technology happening right now. And I think, to be honest, a lot of the smaller mom and pop operators, the smaller regional operators, candidly, they don't have the the capital to invest in a lot of that technology. So it tends to be the larger communities, the higher end communities. So you mentioned virtual reality. I remember being in a community in Boston the first time I saw it. They had a whole room that was dedicated for the residents for virtual reality.
No kidding.
Really?
And it was, maybe I was just touring it as part of, I think it was a ULI experience at the time, but it was great. And I was like, wow, that's fantastic. I haven't seen that in a lot of other communities. And I think, again, you look at the senior housing world and there's a huge spectrum from, high-end, independent, assisted, hospitality-oriented seniors housing, and then the true healthcare, assisted living, memory care, and the technology that's being rolled out there, right? Electronic medical records, and instead of the AccuShield when you're checking in and taking temperatures and tracking who's going in and who's going out, and there's a fine line between technology and safety and freedom of residents, because this is, it's not a hospital, it's not a skilled nursing facility, even if it's assisted, that or in some states they call it personal care. Like, some people have cars, some residents still have cars on the assisted living side, right? They need help with certain things, and so, that technology is a bit of a challenge. Obviously the other part of technology is, marketing oriented website, search engine optimization, the financial reporting side, kind of making the back office more efficient as well. So there's a lot of that technology out there. On the operations side, probably even more so than the resident facing side. People are trying things, though. One community I know was trying to use some robots to deliver meals.
Interesting.
Kind of really pushing that, technology bend. That particular version of it didn't pan out terribly well.
Well, yeah. The New York City's trying that. I walked by one of the police officer robots in Grand Central today. People were ignoring it.
Yeah. So I think it's, the technology is hugely important. There's more of it coming out, learning technology, AI-oriented technology, and there's a lot of investment in it for sure. And so we'll see what impact it has. I mean, at the end of the day, the healthcare aspect of it it's personal, right? It's a human business. It's a care business. Can't be automated, some of that stuff.
Understood.
Well, I guess I was going to kind of curious about how we could go to the other sort of dastardly future question about non-performing loans.
Happy to talk about it. Happy to. So this blends into the conversation we were having on the regulatory environment, right? And we're active. We would love to buy more non-performing loans. We bought one last year. Great opportunity. It was a non-bank financial that just really wasn't equipped to deal with workouts, right? And they just needed to move it off their books, and it had government pay as part of it. Like it was just something that, like, we just want to get out of it quickly, and we were happy to do that. I've seen, at this point, probably 6 or 8 bank sales, where banks are looking to exit. And those are usually situations where they haven't been paid in a long time. I don't know if those are the regulators pushing that. I think those are more of banks are saying, hey, you know what, enough's enough. This has been on our books. This borrower's not paying, difficult. It needs to be somebody else's problem. I expected, frankly, coming out of Q3 and into Q4, banks would start to kind of look at their books and say, hey, let's get rid of some of this stuff and offset it against maybe some profits we're having and get it off by year end. I haven't seen that. So there has not been a mass, sale of non-performing loans. There are lots of non-performing loans and there are lots of defaulted loans for sure right now, because we see them on the other end where it's like, hey, we need rescue capital. We need pref equity. We need mezz debt. And I can't tell you how many times I say, guys, I'm not sure your building's worth the debt. Or I don't think your building is worth certainly your debt plus what you're asking us to put into it.
Yep.
And so that's a challenge. I know the regulators are getting more stringent. I would hope for lots of reasons. I'd rather it come quickly. Like I remember dealing with this in 2007, 2008. Like, I mean, things happened quickly, and that's what maybe, putting yesterday aside, because that was a rally that's going to help a lot of things on the lender side. But I was expecting prior to that maybe Q1, Q2, once there's some marks and people understand where the market is, because I think that's the big disconnect still is they think it's worth 90 cents or par.
Yep.
And I'm telling them, guys, I think you're building, never mind what your debt's worth. Like I think the asset itself is worth 70% of that.
Yep.
And it's losing money.
Right. Yeah.
I mean, we're touching on just a couple topics here. I mean, ZERP, right? During that 2-year period where money was super, super cheap. So you not only put on super cheap debt, but you overbought on the asset, and I'll quote I'll quote Scott Reckler is just, instead of me, but he said exactly what I'm thinking. It's just, we are so drunk off this cheap capital and, and everybody's just rooting and hollering for this cheap money to come back. And you saw the rally yesterday. I'm still shocked that people translated that into 75 basis points are being cut. It's happening. And I think the concern, though, is you still have all this. We have to get back to an equilibrium. We have to clear the system. And part of that is just working through some of these defaults and it getting into the system and just clearing. And, I guess I'm going with a question here in a second, but, are these banks just in pause? So hopefully the Fed's going to bail them out and, or are they just, are we getting into a situation where it's like the Fed's not going to rescue you? You're going to be forced to transact.
Yeah. That's a great question. I think that I think the banks have two things going on with respect to sort of valuation. One is they're getting appraisals that are not incorrect, because I think in a lot of cases they're looking at it over the course of a 5-year, 10-year period, discounted cash flow. Say, hey, this building really should be worth X, right? This building should be worth $10 million. The problem is because there's no capital out there today. If it's losing money to transact on that asset today, you probably have to pay 6, right? Like I just, because there's the lack of liquidity. If the lender, if the borrower are able to stay in that building and it's a good market, and it probably will be worth 10 million, in a couple of years, right? And so they're getting appraisals. And I don't want to throw the appraisers under the bus, because I think they're doing the best they can. And there's not a lot of transactions. That's the problem. And so you have that happening, right? And then, simultaneously, the lenders don't want to take the losses. They say, I think I can get paid back. I got this guarantee. What do you mean? Well, hey, I know who that guarantor is, and I've seen the financials, and their balance sheet is a whole bunch of buildings that have no equity in them. So, but they're not willing to recognize that. And I think they look at the world and say, hey, we underwrote this building. It's a new development to have a 95% occupancy and a 35% operating margin. And yes, things are difficult now, but once we're back to normal, we can be at 95% and a 35% operating margin. That's not where the world's headed. That's not where anybody is underwriting to.
Right.
So that's where there's a really, really big disconnect. And I was going to touch on cap rates a little bit. Like, cap rates have moved for sure in our space. They've moved everywhere for obvious reasons. That really isn't the biggest impact in seniors housing. The biggest impact is what you're capping, right? So all of a sudden, you take a building that's got, hey, maybe we are making more revenue, right? Because inflation's higher and we were able to put 6% rent bumps and level of care pricing. But we're now underwriting and looking at 90% occupancy, right? And we're underwriting to a 25% margin for the reasons we touched on: labor largely, insurance, real estate taxes, CapEx, you name it. Well, going from a 35% margin to a 25% margin without changing your cap rate tells you everything you need to know about valuations. And I got some data here on some, historical assisted living prices from my friends at Senior Care Investors. Average AL per unit pricing was $248,000 a unit in 2019. Call it 250, right? Year to date, $175,000.
My goodness.
Now again, that's asset quality, location, it's noise, but this is the data that's out there, and that feels about right. A 30% decline in values on traded closed assets.
Yeah, I mean, this is something the entire commercial market is dealing with, right?
Yep.
The other thing that the commercial market is looking at is a maturity wall. Depending upon which sector you're in, it's either 2, 4, or 5 years away.
Yeah.
And the senior housing, according to the chart I pulled, was about 4 years away, but it's relatively shallow, if you will. The wall isn't that high. How are you all positioning for that?
Yeah, I mean, well, I guess the height of the wall depends on how tall you are. So, where I sit, I think it's a pretty big wall. We do have the benefit in this industry of HUD financing, which have a lot of longer duration loans, and they're still open. They're active. They've tightened their underwriting, but they're still there for sure. And you have Fannie and Freddie. Again, both of them have cooled off and are dealing with some receiverships and some foreclosures and things like that. So, but yeah, there's not a lot of capital right now in the senior housing space. The big lenders are out. They're just, the Wells Fargos, the Capital Ones of the world. Again, maybe they're doing something one-off, but largely speaking, the door is shut for those guys. Then you've got the super regional guys, and there's a fair number of those that are active. But the deals that can get done today are deals that are really loans under 30 million, under 25 million. You cannot take syndication risk today in this market. It's got to be a single bank deal, or to feel really confident. And so. That wall feels pretty big, Rob, to be honest. It's there. And I'll just add that, having been through a couple of cycles here over the 20 years in the space, like senior housing is always late to the game. They're late showing up. The money flows back to all the asset classes that have, frankly, really good data available, right? It's whether it's multifamily or it might come back to office before it comes back to seniors, because you have much better data available. You got industrial, you got so many other places before you start chasing sort of senior housing, even though it's matured a ton over those 20 years and become much more institutionally acceptable. But similarly, like money's going to flow other places before it comes into our space. And we were actually benefited from this effect late last year, where the world had fallen apart largely for the multifamily world and other traditional real estate asset classes, but we ended up with another quarter or two where we could get deals done for whatever reason.
Right.
Well, it's interesting. And I just want to talk a little bit about like trough and duration, right? And again, it's tough to put away what happened yesterday with the Fed's decision, because now we feel like, now we're at trough and we're getting back to, we're gonna start transacting again. But you talk about the height of the wall, right? So are we at trough now in terms of pricing? I mean, do we have more to fall? More than the 30, 35%. And then, talk about that maturity wall in terms of the duration. How long is it going to take us to kind of work all that stuff out?
So my answer on, are we at the trough? No, I don't think so. If we are, we're at it's more U-shaped and we're at the front end of it. I think these prices, we're buying a high quality asset out on the West Coast, developed, I don't know, 5-7 years ago. It opened under 200,000 a unit. You couldn't build it for probably 300,000 a unit. It's a well-performing asset. So I think that the stuff that's going to trade over the next 12 months is going to be at a much lower price per unit, because it's the stuff that they wanted to sell last year. They couldn't sell. Stuff they're selling this year. I'm telling you, I mean, we just put a bid in on something that under 70,000 a bed, slightly older building, but I think you're going to see a lot of those trading. And we're involved in a transaction on a newer asset, developed, never leased up, probably an oversupplied market, and that's close to 130,000 a unit. And that's something you'd look at and say, well, that's a Class A building, institutional quality product. There's no way it should trade for that amount. But that I think what's going to happen, you're going to see prints that are lower, and that's going to provide some cover for more transactions to happen through the year. So honestly, I think that number comes down throughout 2024 and then probably stays there maybe through the first half of 2025 before the quality of the assets being sold are stable and the capital markets return.
Well, James, I mean, listen, we covered operations, we covered COVID-19, the stress, we covered a lot of ground here, and we could just take one of these topics and spend the entire session. But so we've obviously covered a lot of ground. But what haven't we talked about? I mean, what else is apropos to the topic here? Latest on senior housing. What do we miss?
I don't know. I think we may have touched on all of it at this point. I mean, I think what we were maybe missing is the upside here, right? I mean, it's a great industry. I think the next 2 to 3 years are going to be an opportunity to buy things that you couldn't have bought several years ago that will be fantastic assets for the next 10 years, the next 20 years. Like, when you look at the sort of, the resident profile and the 80 plus age cohort, like it really starts to gain steam in 2027, 2028, right. 2029. Like that's
right.
And there will be alternatives. I mean, I think there's going to be more home health care. There's going to be more options. Mm-hmm. We certainly didn't talk about active adult. That's a huge growth area. Again, I consider that multifamily. That's not something I spend any time on, but it will start to compete with the independent side of things. And then when you take active adult and bring in home care,
yep,
it'll start to change. So I would say the upside we haven't talked about. It really is a great industry. I would say it is recession resilient. The impacts that we're feeling, you're spot on, are COVID related. These are not economic related. These are not recession related. If anything, you could look at this and say, God, if you're a 75-year-old and you've been living in your house for the last 20 years, 30 years, 40 years, your home value just went up 40%. That's
right.
Could be your biggest asset, especially for a middle income type of resident. Most certainly their biggest asset.
And or anyone who lives in New York.
Or anybody who lives in New York, exactly. Or Fairfield County has benefited substantially from work from home. And so I think when you look at some of those dynamics, it really bodes well. There's very little new supply coming online. There's a ton of demand coming. It's not coming next year. It's not coming the year after. Like I said, there might be negative inventory growth. Capital is out there. Like I said, you have Fannie, you have Freddie, you have HUD. So with all of those things, you have lenders that will bridge to those. So,
yep.
I think once the world gets their feet under it, the capital markets get their feet under it, it's got a lot of great fundamentals. And then the other thing for the residents, I mean, getting a return on their bond portfolio is actually a meaningful thing, right? I mean, these residents, and this was something why the recession in the great financial crisis was totally different in its impact on senior housing, and specifically on like entry fee CCRCs, was residential real estate values dropped, right? Mm-hmm. Interest rates went to zero. Seniors portfolios that were yielding, $100,000 a year in income, right? If they had a nice nest egg, and now they're yielding $30,000 or $40,000 in income, right?
Right.
So we've come the other way. So I think when you look at the fundamentals, the tailwinds of the resident, of the industry, it's all favorable. And one of the things I'd point out, occupancy is coming back. It is still low, and it was low coming into the pandemic, right? I mean, we don't need to get back to pre-pandemic levels. We need to get back to 2017 levels. We need to get back 90%, 92, 93% to have a healthy industry and operating margin. But where we sit today, there's more seniors in senior housing communities and units that are occupied than there's been at any point in history. So, all those units that were built and overbuilt and oversupplied, there are residents still moving into them. So the concern of, is there a perception issue, right? Is there a stigma? Mm-hmm. I don't think so. I'm biased, right? But no, I really don't think so. I think you really have a setup for a phenomenal next 2 to 3 years to deploy capital. And I think that should be the takeaway.
Absolutely. Oh. Well, listen, James, obviously you're a busy guy. We appreciate you taking the time to speak with us
very
today.
Much.
And,
this has been great.
Exceptional conversation.
Well, thank you. No, this is fun. I love the space, and it's great to do this with you, Patrick.
Perfect. Well, take care. Happy holidays.
Thanks, everybody. All right.
Thank you.
Bye-bye now.